Hello and welcome to our next video in the series on buying a house. This video covers the Help to Buy equity loan, not to be confused with the Help to Buy ISA or the Lifetime ISA. If you want to learn a little bit more about the Lifetime ISA, we do have another video available in this section on our website. So I want to go over the general features of the Help to Buy equity loan. Now I know this information is fairly readily available on the internet, but I think what isn't is some of the potential drawbacks. So I'm going to perhaps focus on those a little bit more today. So what is it? The Help to Buy equity loan is an investment from the government to you to assist in the purchase of a brand new property. It is only available on brand new properties, but isn't exclusive to first time buyers as some people would have you believe. Now I use the word investment rather than loan because I think it better describes the government's position. They are after all investing in your property, not just loaning you money. The investment/loan for your property will amount up to 20% of the value of the purchase price, or 40% in London. You then have to put down a minimum of 5% deposit. The total deposit is then 25% minimum. The remaining 75% can be made up with a mortgage or further deposit if it's available to you. The investment or loan is then interest free for the first 5 years, after which you will pay 1.75% interest on the original loan amount. That interest rate will increase each year by RPI plus 1%. So that sounds quite simple, right? And essentially like free money, and it sort of is, but there are a couple of drawbacks which I'm going to try and go over now. So the key thing to understand here is that this is an equity loan. The government are essentially buying a portion of your house. They're not just lending you money. They will essentially own 20% of your house. So that means that if you purchase a property for £100,000 and the government invested their 20% at £20,000, if then later down the line your property is valued and sold for £110,000, you will repay the government 20% of that £110,000, which is £22,000 in this instance. So that's how the government are essentially making their cut, as well as the interest we talked about before. Now that doesn't sound too bad, does it? But let's just play with that scenario slightly. So let's say that the property you sold for £110,000 was actually valued at £120,000, but you were forced to sell slightly below the asking price. So the government's 20%. That 20% is going to come from the value, not from the sale price. That means that the government are getting a slightly higher chunk of the property than you are due to circumstances of the market that potentially could be out of your control. Now that's especially important when you consider that new homes are generally sold for a premium, slightly above the actual value if that property was not new, because they're nice and new and shiny. That could mean that if you're selling within the first few years, or potentially longer, you may struggle to recoup the original value you paid for it. The latest data I can find shows that sellers are agreeing a sale price that is approximately 3% below the asking price, and that properties, roughly a third of properties, actually have their value cut before they're sold. What that means in practice is it's very common for people to sell below the asking price. That potentially means that the government are walking away with a higher percentage of the value versus the actual sale price that you've sold the property for. That really eats into your profit or your gain. There are, of course, as well, lots of instances where people's personal circumstances dictate that they have to sell below the asking price, maybe because they're particularly motivated to sell quickly. That then becomes a much bigger issue for those people.
So, what happens after the first 5 years if you want to settle this loan or repay the government investment? You can do that, but you have to pay it off in 10% chunks. And I'm not just talking about 10% of the original loan amount, I'm talking about the minimum repayment value is equal to 10% of the purchase price of your property at that point in time. And every time you want to make a repayment, you will have to pay for an independent valuer to value your home.
This differs to a mortgage. You can't pay a monthly premium or repayment to knock down that debt. It has to be in chunks, which for some people is likely to be less realistic. I think ultimately it is a fairly good idea and will work well for many people, but there will be some people for which it really could hinder them, and I don't think there's necessarily enough information out there for people to be aware of the potential drawbacks of this product. It has been criticised by a number of people as more of a product to help house builders sell their products rather than help people get on the property ladder, and I can certainly see where that criticism comes from. Okay, so that's it for the Help to Buy equity loan video. If you have any more questions on Help to Buy or anything else we've covered in this series of videos, please do send us a message, whether that's on the website, through Facebook or LinkedIn. Thanks very much for watching.